debt is not equal. Productive debt and non-productive debt. That's usually how I like to describe it. We need to understand what's going to help us create wealth, because there's a right time for paying off debt and there's also a right time for taking on debt. Hi guys, today I want to talk about the power of leverage and also the mindset of debt. A lot of the times people are afraid of taking on debt, and I get it. It's very normal. When you buy a property, you're taking on additional debt, there's going to be additional repayments. And people wondering, why do I do interest only when I should be paying off the debt? Right? We were taught from our parents and from other people that having debt is bad. But there's two types of debt. There's good debt and there's bad debt. What we want is good debt. Debt is not equal, right? You've got productive debt and non-productive debt. That's usually how I like to describe it. So productive debt is debt that actually is tied to income producing assets. And in Australia, you can get negative gearing benefits when you have tax deductible debt, because when you have debt, you can actually claim the negative gearing, which is the interest expenses and also the related expenses to the property. So that type of debt is actually going to help you grow your wealth, because the debt is tied to an income producing asset that generally improves value over time. Non-productive debt is generally things that are tied to depreciating assets. So if you take on debt to go buy cars, buy boats, buy things that are not increasing in value over time, that is what we call a non-productive debt or non-tax deductible debt. So we need to understand how to use debt, leverage it, and also use it as a tool when you're growing your wealth. And if I look at how people can grow their wealth over time, we need to understand what's going to help us create wealth. Right? And in the beginning, we generally are short on cash, right? When we buy a property, a lot of the time you need to front up a deposit. Traditionally, people think that you need to come up with a 20% deposit. However, the aim of the game is actually to get into the property market with the least amount of cash, because that means you can use less dollars to then go buy a property that's going to increase in value and produce an income for you. So why do a 20% deposit when you can do a 10% or a 5% deposit? As an example, right? So generally speaking, we want to leverage. Leverage is what's going to give us power to get into the market sooner. And if you buy sooner in today's dollar, you're actually buying it cheaper than tomorrow's price. So that's the aim of the game, to get into the market sooner so you've got more exposure to the property market earlier. Because the biggest advantage that people have when they start investing is time. If you start investing earlier, it means you've then got more time for growth in the market. And as I mentioned in the previous video, I like to break down the investment cycles into 3 phases. So you've got the accumulation phase, which is aggressively accumulating and acquiring assets during a short amount of time. Then you go through a period of growth and holding. Right? And then during that phase, it's about managing the portfolio, holding the properties for a long enough period of time to see growth, right? But we want to spend more time in growth than the acquisition. And then later down the track, when you're at a position where you can sell down or pay down debt, then we start to get to that passive income retirement phase. In order to get to that asset base, we need to use the leverage, right? And our mindset around debt needs to be very different. Right? We're using debt to buy more assets. And if you can structure your lending in a way to be able to do that, you can actually build your portfolio quickly and also scale up faster. But the key is to make sure you manage your cash flow, right? And I've always had this mindset that if I take on more debt, yes, it sounds scary, but if the cash flow is covering majority of the repayments and it is increasing over time, which it will, because generally speaking, when you buy properties, the rental income goes up over time with inflation. So that ultimately means you've got more cash flow coming in every year. And if the cash flow can sustain the debt repayments, and over time, traditionally, because the asset value goes up, the cost of debt relative to the asset price will actually drop. That means it's easier for you to hold that asset. Right? And this is why I'm a big believer when you build the portfolio during the acquisition phase, it's much better to do it interest only, right? Because there's a right time for paying off debt and there's also a right time for taking on debt. And during the acquisition phase, we don't want to pay off debt because we actually want to build the portfolio by taking on more debt. And when you go to your tier 2 and tier 3 lenders, how they're reviewing your servicing buffers is actually looking at your cash flow. So if your cash flows are not as strong because you've got your loans all on principal and interest repayments, which is usually going to be about 20 to 30% higher than on interest only, then it's going to drain a lot of cash flow from the portfolio. So therefore, it's not the best way to scale the portfolio as you grow. So interest only really gives you the benefit of having better cash flow, lower monthly repayments, and negative gearing benefits associated with the property, which is largely going to be the interest repayments of the loan. So have a think about it. It is a very big mindset shift because often when we start out, we're always taught to pay off debt, but that is more in relation to having an owner-occupied property or bad debt. Right? That I definitely agree with. You want to pay off that type of debt because the interest on those loans are not deductible and there is no negative gearing benefit on those types of debts. So therefore we want to pay down that sort of bad debt, and then we want to take on good debt, which is producing income, right? Producing tax deductions and also negative gearing benefits. But that's how I've been able to scale my portfolio, is by using interest only repayments and loans and using a range of different lenders to be able to help me scale the portfolio by borrowing more debt, right? And that debt is then tied to assets that are growing in value. If they're growing in value, I can then recycle that equity into other properties that are producing additional income and cash flow. So have a think about it. That's the way that I would like to encourage you to think about how you can use debt to build your portfolio over time.